Welcome everyone to our latest webinar. Thanks a lot for making the effort and dialing in. Let me wait. Before we get started, it might be good to set some rules. So I think for today, what you can expect is we will talk you through kind of the current climate tech market in our latest fund, Fund 4. We won't go into detail into our prior funds or other strategies, mostly our infrastructure strategy or our lower ticket strategy as of 20K. If you have interest in any of these other products or you want to update on your prior portfolio, do reach out to us separately. There is a chat. Feel free to write your name and your role. It's always nice to see who's in the webinar and we can exchange questions or comments. If you have questions, there's a Q&A section, but you can also use the chat function and we'll try to either answer them directly if relevant, or we just wait for the Q&A section at the back end of the webinar. The agenda for today is first a refresher on who's Carbon Equity and what we actually do. Then Carolina will talk you through the climate tech opportunity and why we think it's interesting actually to invest in climate today. And then I'll talk you briefly through our latest fund, Fund 4, and then we should have time for Q&A. We have 45 minutes today, and Carolina and I are going to do hopefully our best to stick our presentation to 30 minutes, so we have ample time for questions. Very quickly about us. So you see Carolina on the call as well. She's been with Carbon Equity from the start. She's an investment manager, has been involved in, I think, almost all of our investments to date, knows the market extremely well, especially the US market. And myself, I joined right after Caro, so I've been here almost for 3.5 years. And before this, I spent 7 years at AlpInvest, one of the largest fund investors in the world. So very briefly, for who's not familiar with Carbon Equity, we're one of the leading climate investing platforms where we invest in climate funds, really from venture capital to private equity and infrastructure. Over the years, we've raised over 300 million, which we deployed over 25 underlying climate funds across several of our portfolio funds. But we'll talk a bit more about that. But just know that we look at the whole market. We're following more than 500 funds, and very selectively we aim to invest in the best climate funds out there. We specifically set up a fund of funds structure because it's hard to invest well in private markets to start off with, but especially in climate tech, as it's a bit of a newer market and you really want to build diversified exposure. Climate sounds like a niche, but it's actually quite a broad market. So by setting up fund of funds, we build really diversified exposure to early stage, late stage, hardware, software, Europe, US, and we allow our investors with a low minimum to get access to these best funds, who typically have a 5, 10, or sometimes even higher minimum amount, which we can meet at fund of fund level, and then our investors can get in with a ticket as small as 50 or 100K in our flagship program. And we do this with one of the most specialized teams in the climate domain. I won't go through the full team, but just know we have a big investment team of 8 people, which is headed by Wiebe Visser, who I know very well from my time at AlpInvest. He spent there over a decade. And before that, he spent a long time at JP Morgan. Very seasoned investor. And I think it's also nice to highlight Lisa. She's one of the co-founders, and she's the one who's heading our climate efforts. She used to be a decarbonization specialist at McKinsey, so she knows how to get to net zero and knows which technologies are most important to get there, and really make sure we invest in the right technologies. By investing in funds, we aim obviously to have exposure to the leading companies leading the energy transition, and it's very hard to get access to these companies directly, but by investing in the best funds, we can actually get access to these companies, which is very exciting. And also we don't have a 100% view of which technology will be the clear winner 10 years down the road, but we have a pretty good view which kind of technologies will play a role. And by our strategy of investing in the best funds, we just build exposure to multiple pathways to solve different problems. So for instance, we have exposure to Form Energy, which is really one of the leading companies building medium duration energy storage. So these are huge battery facilities that are not using lithium ion, but rather iron air, which is very cheap and allows them to store energy for up to 100 hours, which is really exciting. We have exposure to 12, also a company out of the US that makes sustainable e-fuels, jet fuel out of CO2. And they recently signed a huge offtake agreement with one of the largest European aircraft companies. So it's very exciting. Fervo is one of the leading companies in geothermal, also in our US portfolio, based out of California, where they signed multiple huge offtake agreements with data centers that want clean baseload energy. And I think geothermal is a great way to get at. So wind and solar are amazing, but not always there. And geothermal is always there and very important, especially given the recent boom around AI and data centers. Geothermal plays a very important role. Another company to highlight, and then let's move on, is Sire, is one of our companies here in Europe. They developed the technology to recycle polyester in a very efficient way, and they recently, and as part of like the foundation of the company, they teamed up with H&M, and as part of that transaction, they also signed a 600 million offtake agreement for their product once their factory is actually up and running. So by our fund of funds, we get exposure to over 150 plus companies, and a few of those will be very exciting and drive the majority of the returns. And these are just some examples of companies where we expecting a lot of excitement and returns from. We're now launching our Fund 4, which is a continuation of the strategy we have been pursuing since 2022. So as you can see over the years, our funds have grown in size, but the strategy has remained relatively the same with some nuances. So first is that over time, we also started to deploy what we call co-investments, but I'll touch on that a bit later in the webinar as well. But mostly in terms of stage. So Fund 1 was invested to a large extent in early stage companies, which is also a reflection of the market. But we see with the climate market maturing, we see more companies growing to later stage rounds, and we're also therefore investing more later stage funds. We're at the back end of investing Fund 3. So as you see, we haven't fully invested Fund 3, but we're about to make the final 2 commitments, and then we'll start deploying out of Fund 4. If you look at the performance of our funds to date, it remains early days. With a fund of fund, it takes a bit longer. But if we look at the underlying data, so it's all the portfolio companies, and it's roughly 200 already. If we look at the year at which our funds invested in those companies, all our investments out of 2021 are in aggregate held at 1.4 times, which also includes follow-on capital deployed later. 2022, 1.3, 2023, or 1.2-ish. And this data is per end of 2024. So we see a small uptick already in 2024. So we're just very happy with this result. It's promising early innings. And it means we're just, with our first, 200 investments and roughly 3.5 years underway, on track to meet our target returns, which is obviously important. We're aiming to drive a lot of climate impact with our investments, but they also need to be sound financial investments. Handing over to Carolina to talk you through the climate tech opportunity.
Thanks, Bas, and hi everyone. Nice to be with you today. We wanted to provide a bit of context and really a backdrop as to what is happening in climate tech today and why are we still active in the space? Why are we still excited about it? What are really the key drivers behind it? So to first set the scene, this is just a slide showing you the global investment in both clean energy infrastructure and fossil fuel infrastructure over the last 10 years. And you can see a couple of things. First is that over the last 4 to 5 years, global investments in clean energy have been higher than fossil fuels. Fossil fuels have been decreasing over the last 10 years steadily and at best staying flat, while we continue to see exponential growth in clean energy investments. And you could even see that we're soon going to be at a stage where clean energy investments are double that of fossil fuels. And why is that happening, besides the fact that we should solve climate change? Well, the first reason is that renewables are really fundamentally more efficient than fossil fuels. Why? What do I mean by that? So when you generate electricity from fossil fuels, be that you're burning gas or maybe oil, you have quite a bit of losses, primarily in the form of heat. So you're burning it, so there's heat that is lost to the environment, and the remaining portion is only really generating electricity or kind of the final energy output. Whereas with renewables, pretty much 100% of the energy, the primary energy that you source, is directly created into electricity. So if you're comparing technology and technology, it's just fundamentally more efficient. And you see that if you apply renewables to any other technology, like, for example, passenger vehicles or heat pumps. In passenger vehicles, there will still be quite a bit of heat loss in internal combustion engines when you use fossil fuels. But in electric vehicle, this is really reduced to only about 10 to 15% of loss. And that's primarily in the charging and discharging of the battery, but there's no real thermal loss. So that makes clean technologies fundamentally at least twice as efficient as fossil fuels. And then another reason is that clean technology, as the name says, is a technology, right? Not a commodity. So as you continue to manufacture and deploy it, there's learning curves. We learn ways to how to make them faster, better, and you gain economies of scale. And the other part is that we continue to innovate on these technologies. So we continue to find chemistries that are superior and that continue to reduce costs. And there's actually almost a formula identified by now that as we continue to double deployment of clean technology like solar and batteries, there's a 20% reduction in costs for every doubling. And this continues to happen. So we at Carbon Equity really see this foundation of cheap, massively deployed solar and batteries as the bedrock, the foundation of the energy transition. So if we go to the next one, essentially the economic flywheel or the economic cycle that we see in climate tech is that as renewables and batteries continue to decrease in cost due to innovation and deployment, all the rest of the climate technologies that rely on renewable electricity will then also reduce in cost. Because, for example, if you're thinking of your electric vehicle or your heat pump, but also if you're thinking of electrifying an industrial process, all of that relies on having a foundation of renewable electricity, and that tends to be one of the higher costs for climate tech. So if that is reduced, then everything kind of moves forward together, and we can continue to electrify more sectors of our economy. And that in turn, as we continue to electrify, will lead to more deployment of solar and batteries, and the flywheel kind of remains. So it's that combination of renewable electricity and the ability to make it more stable through batteries, so to reduce some of that intermittency, that is the superpower behind what we're investing in. And we also wanted to provide some historical context and some of our insights into what is happening in the climate tech market today. So if we start with looking back, it might sound like climate is something that has only been happening over the last couple of years, but that's not the case. The first wave of investments in our sector started around 2006 with the wave of Clean Tech 1.0, which primarily happened in the US, in Silicon Valley, with a lot of early stage venture capital investors starting to invest in primarily solar and biofuel companies that were at the time still quite expensive. There was still not much of a market there. So this sector saw quite a bit of large failures, to be honest, like companies like Solyndra that you might have heard of, but also it initiated some of the biggest winners of our sector, like Tesla, or even like SunPower, for example. So that time was quite narrowly focused, really primarily only on solar, and very early. Then, as time progressed, and primarily around the time that we signed the Paris Agreement in 2015, there was a wave of corporates and governments making net zero commitments to align with the Paris Agreement. And that meant decarbonization across multiple sectors. So the scope of what we do broadened. We rebranded to climate tech. That covered industry, buildings, energy, food and ag, really any sector where there were emissions. And a lot of investments were driven into the sectors, primarily also fueled by a lower interest rate environment and a lot of government programs, such as the Inflation Reduction Act in the US. And some investors in this sector since probably mid last year have started talking about a new wave in climate tech that we're calling Climate Tech 3.0 very creatively. And what this is characterized by is the foundation of the energy transition, solar and batteries, being now very competitive in a lot of geographies, enabling other technologies to become competitive as well. It's also characterized by companies and technologies becoming more mature across time, and therefore there is a higher and more attractive growth equity market of companies that are really having commercial traction and are closer to profitability. And at the same time, there have been venture capital investors that have been in this sector since the first or second wave of climate tech that have gotten a lot of learnings and are now raising their funds 3 and 4 and are more established managers. So that's a bit of the historical context. And then moving to today, and specifically 2025, this year, with the Trump administration, what is more difficult today and what could be better? So I will touch on both, let's say, the ups and downs of the current market. The first to mention, of course, is shifting regulation, particularly in the US. So with Trump in office, many of you have seen that the Inflation Reduction Act funding was frozen. That last week, there was a proposal to cut quite a big part of the tax credits that the IRA set out. And we see agencies that during the Biden administration were very important, like the DOE and ARPA, being a bit slower. What this means for climate tech is that, particularly in the US, it will become a bit tougher to build manufacturing plants that require hundreds of millions of dollars, which was easier over the last 4 years with government programs. That's not to say that it's not possible. We actually see many companies in our portfolio being able to do this by pulling in all different sources of capital, like debt, project financing, equity, potentially some grants or philanthropic financing, and putting that all together to build those plans. That's definitely possible. And there's also a lot of climate tech companies that don't need to raise that much capital, that can build a plant with tens of millions of dollars. For example, one of our portfolio companies, Nitricity, that makes green fertilizer, recently announced that they're building their first plant with $10 million. So that's also possible. And lastly, in a market of uncertainty, premiums in general are tough. So companies that need a green premium, so where their product is much more expensive than the way we do things today, that will also be a bit tougher in this market. But again, that's not all of climate tech. So there continues to be a lot of sectors, particularly things that can be incorporated into existing supply chains or that increase efficiency, that continue to be very attractive. And actually in this market, regarding policy, there's several subsectors that we think will actually see tailwinds. And why is it the case? So first, focusing on the US, there's several aspects of what we do that align with the Trump administration's priorities around strategic independence, particularly when it comes to energy and materials independence. So the US right now is very focused on expanding 24/7 energy sources, so energy sources that are not intermittent, like fossil fuels, but also like advanced nuclear and advanced geothermal energy. The Trump administration is also supportive of deregulation across the board, but also when it comes to the energy grid. It's been very tough in the US over the last 10 years to build new transmission and distribution lines, power lines, and that has made it actually quite hard to get renewables connected into the grids. This is a problem worldwide, but that could also be a benefit coming out of the coming years in the US. And lastly, you've seen, of course, the trade wars in the news Trump is very focused on decoupling and reducing dependency from China. And a sector of particular importance is critical minerals. So all the metals and minerals elements that are needed partially for the transition and for other manufacturing processes like copper, lithium, etc. So we put some clips here of executive orders that we've seen in the news in the past months that actually support our portfolio. So one is in terms of expanding critical mineral production in the US. One of our portfolio companies, Vacuumschmelze, received support from the Department of Defense to produce their rare earth magnets. So these are magnets that are used in electric motors for EVs, but any kind of electric motor as well. And Vacuumschmelze is the only Western producer of these motors. So they've become almost a national security priority for the American government. And we've also seen portfolio companies in geothermal and nuclear receiving support from the Department of Defense or the Department of Energy over the last couple of months. And if we turn to the EU, we're quite pleased to see that over the last couple of months, Europe has continued to double down on climate tech. The Clean Industrial Deal was announced about a month ago or so. It's been in the works for a long time, but there were more details announced now, and some of them includes a 100 billion euro decarbonization bank that will fund clean tech and green manufacturing in Europe. There's also more rules around Buy European and supporting local production of clean tech components made in the EU for EU projects. And there will be some important support to reduce barriers to deploy technology in Europe, particularly around permitting, which has been a bottleneck here. And similarly, over the last couple of months, we've seen many tailwinds in terms of, again, the critical mineral topic, but also other companies like Reverion that makes electricity out of biomass receive funding from the EIF as part of their resilience project, which is a project meant to, again, focus on energy independence in the continent, given that we are trying to reduce our own dependence from Russia in this topic. And besides politics, some other trends to focus on that are also in the news over the last couple of months is importantly AI. So AI is definitely a double-edged sword when it comes to the energy transition, because on the one hand, it demands a lot of energy use, and that's what you can see in this in this graph. The amount of power, IT power needed for data centers has doubled in terms of our expectations over the coming 3-4 years. And that is really due to specifically the power needed for the AI data centers. And on the one hand, there's a lot of kind of movement of energy going to these hyperscalers. But on the other hand, it's also important to realize that these hyperscalers, Google, Meta, have a very high willingness to pay for energy because they have strong margins on these products, and they need energy quite quickly. And renewables, in many scenarios, are able to provide energy even faster than fossil fuels and set up quickly. So we see AI as potentially a tailwind as well for our portfolio, because there are several companies that needed to go through those learning curves. And now there's clients like Google that are signing contracts with companies in our portfolio and being willing to take that green premium because they need energy right now to power the data centers. So for example, Elemental Power is a nuclear power plant developer in our portfolio that received a contract with Google, and so did Fervo Energy that Bas talked about earlier.
Thanks, Caro.
And now,
no, thanks. That was super helpful. So we quickly wanted to touch upon the latest fund we recently launched. It's called our Climate Tech Portfolio Fund 4. We're aiming to raise 125 million to continue the same strategy as we've done before, as I touched upon earlier. And we aim to invest in funds that start investing this year or next year, and so really benefiting from the all the learnings in the market and kind of the new investment environment Carolina just talked about. We aim to build exposure to at least 150 underlying companies and have a target return of 2 times your capital, which translates roughly into a 15% net IRR, so kind of your yearly return. And the fund has a lifetime of 12 years, but all the underlying funds we invest in have a typical 10-year fund life. So the strategy for the fund is to do roughly 80% in underlying fund investments, so really the fund of funds we've talked about before, and 20% of the fund we reserve for co-investments. So these are really direct investments where we invest directly into the companies without a underlying fund level. And I'll talk a bit more about that in the next slide. So in terms of stage, a minority of the funds will be really early stage. So let's say 10 to 20%. The bulk of our fund will be early growth. So these are typically around a B or C round. So if it's a hardware-driven company, typically you have some kind of minimum revenues because your demonstration plant is up and running and you're really going to use this capital now to really scale up to build a very large factory. But we also invest in a lot of software companies, and by the time they do a Series B or C, they're generating tens of millions of revenue. And we have a lot of companies in between that have a hardware component that can be off the shelf combined with software. So it's a mix of pre-revenue companies, but they've developed their technology. It's actually working, and now they just need to really scale up or just giving more fuel to companies that are actually growing quite fast already. And 20-30% of the fund will be reserved for really late stage growth or even buyout transactions. So really profitable companies. If it's buyout and the late growth, typically companies doing in the like 50, 100 million plus revenue, it could be profitable if they would stop investing into growth and they really want to raise more capital to continue to grow. I think for us, it's really important that the companies we invest in really grow to a large extent. Also from a climate perspective, you can have an amazing technology, but with 10 million of revenues, you're not achieving anything. We really need to build these companies into the hundreds or billions of revenues. We diversify our fund across Europe and the US. It probably will be a bit more tilted towards the US, 60%. 40% in Europe. We just see more high quality fund managers and more high quality companies there. Although it's interesting to see what will happen, we see a lot of our US funds look more into Europe. So in the end, the underlying portfolio could be more 50-50 as a lot of our US fund managers are actively deploying a bit more into Europe. And we aim to diversify over all the climate sectors, with energy and industry being the most dominant sectors. These are huge industries in itself, so there's a lot to play there, but also a lot of the emissions sit here. As I mentioned before, we will do more co-investments. So our Fund 3 aims to do 10%. With Fund 4, we're going to go for 20%. And we just have a huge pool of companies through the funds we committed to, where we can choose to participate in any future rounds, which will also lead for us to deploy capital faster and hopefully have earlier distributions. And on these co-investments, we don't pay any fees or carried interest to the underlying fund managers. So from a financial point of view, it's very interesting. So what we're looking for is really growth companies. So there should be no tech risk. There should be ideally at least 10 million of revenues. One of our fund managers that we know well has already invested in the company before. They know the company well, and they're doubling down and continue to put more capital in the company. And obviously, we want to back also from a climate perspective, the technologies that we really believe that matter. Sometimes there are a few portfolio companies in our portfolio that focus a bit more on biodiversity or climate adaptation. That's not what we want to double down on. It should be really about decarbonization. So just to give you a flavor of the prior co-investments we have made, Luxwall is one of our investments in the US. They produce a vacuum insulated glass that is as thin as single pane glass, but has the insulation value of a brick wall. So it's even better than triple pane glass, which is amazing because there are a lot of buildings with single pane glass, and it's very expensive to replace that for double pane, because you don't need to replace only the glass, but also the whole frame. And with this vacuum insulated glass, that's not an issue at all. It's a technology fully developed in the US and manufactured in the US. and they're growing super fast. Their first factory is up and running, and they're currently building their second factory. We've also invested in a company here in Europe called Aerones. It used to be more a drone company, but it developed now more into robotics to service the wind turbine industry. So obviously, when you need to do maintenance at a wind park, it takes you need to shut down the wind park, and it used to take a lot of time because people need to climb into the wind turbines or even drag them up in ropes to do all kinds of repairs or paint jobs. And they've developed all kinds of robotic technologies to just send robots up, which makes sure that the downtime of a park is substantially shorter, which is very important. So they're working with some of the largest wind OEMs, including GE, Siemens, Vestas, and they're growing super fast. But as I mentioned, we're not paying fees and carried interest on these direct co-investments, which is also interesting from a fund of fund perspective. So fund of funds typically also means a double layer of fees. The underlying funds have their fees and we have our fees. But as we invest 20% of the fund without the underlying fees, the economics do materially change. So while you would typically, if you would invest in one fund, pay a 2% management fee and 20% carried interest, with carbon equity, depending on your ticket sizes. So this is based on a 250K ticket. You pay approximately 2.45 in fees, but only 16% carried interest. So a bit more fees, but lower carried interest. And by that, you get a way bigger portfolio, way more diversification, lower risk profile, and also access to the best funds, which is very important. Here in Europe, it's easier to get access to most funds, but especially in the US on the West Coast, it's not easy. And our co-investment just helped to reduce the fee pressure on the fund. With that, I think we've almost come to the end of the webinar. I think we're well on time, so well done, Carol. We just wanted to mention that we're doing an investor evening also live at our office here in Amsterdam, June 3rd in the evening. So obviously a webinar is nice, but it's very distant. So if you also want to meet us, please come to our office June 3rd and join the investor evening. If you can't make it, just reach out to someone of Carbon Equity, and I'm sure you're more than welcome for a cup of coffee on another day and to meet some of the team. I think with that, we just want to open up for Q&A. Carol, did we receive any questions?
Yes, there's a couple in the chat. So the first one from Barrett is, what is considered technology in Climate 3.0? Is it just solar and batteries? No, definitely not. So maybe I can give a couple examples. What we mean by competitive is something that is either directly price competitive or very, very close to. So a couple I can think of in our portfolio that are really more technology innovations. One is maybe Rondo Energy. What they do is they decarbonize industrial heat. So they have what they call a heat battery made out of a lot of bricks. They use renewable energy and batteries to charge that brick battery that then converts it into heat, and it can store heat as heat. And then that can be used by industrial plants to, for example, make down the line cement, but also pulp and paper and really any kind of industrial material. So that is more of a technology innovation. And then the other I can think of is Harbinger. They're a company that is making medium duty electric vehicles. So these are kind of class 4 to 8 trucks. So not the massive trucks on the highway, but more your delivery truck. That before we couldn't electrify because batteries were too expensive. And by now that's possible. So we can do it as well. So these are a couple in our portfolio that really focuses more on technology innovations that build on top of the cost curves in solar and batteries. We have a couple more questions. One is from Mark on our view on climate tech pivoting to a defense tech messaging or positioning. Happy to give my take here as well. So especially in the US, what we've heard from our fund managers is that the administration can be quite punitive on language. So it's not really about the fundamental of the technology and what they can achieve, but it's really if you call something clean climate or in a similar way, in a different topic, diversity, inclusion, these are words that they automatically exclude, whereas the benefit of a technology could be very much in line with their priorities. So messaging can help them receive still government funding from the Department of Energy or the Department of Defense without really changing what they're doing. So we think as long as companies are not pivoting on their actual business, but it's simply a way to explain to the administration why they can be beneficial. For us, that's at least in my book, positive. And a couple more questions. From Aviva, what is your perspective on changing priorities in the EU versus national, domestic, and foreign policies? For example, the Dutch government moving to end climate adaptation funding and exit climate agreements. Any of you, Bas?
Well, you go first. I'll chip in.
I personally haven't heard this about Dutch government moving to end climate adaptation funding and exit climate agreements. So I'm not sure about that.
No, me neither. But like so first of all, we see a lot of funds also broadening their scope, right? And it can be related to the first point on defense, right? Some technologies could be dual use, right? And there we have, for instance, satellites, very important for wildfire detection, all kinds of climate data, but could be used for other instances as well. But we see a lot of funds also broadening their impact scope with climate adaptation, which is fine for us. The latter, dual use, can be more challenging if it's depending on what the other use is. The way we build our funds is really focused on having at least 70% exposure to what we call net zero technologies, substantial net zero technologies, and the remaining exposure is fine. What we see country by country level, obviously we would love to go back to the old era where every other country and company had a net zero pledge. In the end, we're trying to invest in technologies that can beat on economics, on price, efficiency, and the product. And again, I'm not exactly aware on the Dutch regulation, but our portfolio is not so dependent on country by country level. I think on the EU level, that is important, and EU needs to step up, and EU is really hard trying to step up to replicate kind of the successful loan program out of the US and some of the IRA here in Europe. That will be most important, because over the past years, what we saw is that Germany is trying to back one of their electrolyzer winners, and then Spain might do the same with too small amounts, right? Like 12 million here, 8 million there. We need to be united as Europe and like back the best companies regardless of which country they are. And we're seeing positive signs there. I think that's really more important to us than country by country level.
Couple more questions. One is from Samson on how do we see African countries in terms of competitive technology? I think there we have at the moment very limited exposure in our funds to technologies coming out of Africa. We've seen in general more activity in emerging markets in the last couple of years, as there's place, for example, such as battery swapping, where we have exposure to one company, for example, out of Brazil doing that. But at the moment, little exposure to Africa, so I can't comment on that one so much, unfortunately.
Yeah, so the one market where we're spending more time, but we haven't found the best fund is really Asia, a region. We do see, obviously China is a humongous player in the energy transition, but it's a very, very tough place to invest. So we're not looking to build exposure into China. But there are obviously a lot of other countries like India, Vietnam, Indonesia, where it actually is exciting to invest. But the ecosystem is there very immature. So far we build a bit of exposure through our funds that might invest 5 or 10% of their funds also in Asia. We continue to scan the market, and we have ongoing dialogues with a few managers in Asia. So maybe we add a manager at some point that also focuses on Africa or Asia. But it's not high on the pipeline of Fund 4, as they're just more proven managers in the more Western economies. Also taking FX and all kinds of other risks into consideration.
And there's still more questions coming. One from Rick: do you consider investments in new funds? So I guess this could mean either a new relationship for us or a first-time fund. So if I look at our pipeline for Fund 4, there's several of our existing relationships that are coming back to market. I think about 4 of them, but we will definitely continue to make investments in new relationships, new funds. As it comes to first-time funds, it's something that we did a couple of times at the beginning of carbon equity when the sector was relatively still, immature and growing. At the moment, we see so many established players that it's highly unlikely we would consider it unless the fund would really add something extremely differentiated that we can't find through another player. And one last question from Miriam. What's the difference between your climate tech funds, such as Fund 2, and your climate tech portfolio funds apart from minimum ticket size? I assume this is comparing access to climate tech with our climate tech portfolio funds.
Yeah, I can take that. So our flagship fund 1 to 4 is really a global strategy, and due to regulation, we have a minimum ticket of 100K and 50K if you're a professional investor. If you classify yourself as a professional investor, but part of the mission of carbon equity is also to democratize access, and we want to go lower than 50K. So we've launched a new fund called with the LTIF regulation. But due to the LTIF regulation, we're bound to certain restrictions. So the fund is a bit more European focused. And therefore, we've also added infrastructure as part of the strategy there. So it will invest in a part of our portfolio, what we do with Fund 4 as well. But some of the US funds are not in scope for that program. And since we also run a fund of fund for infrastructure, for those who are not familiar with infrastructure, by the way, it's a lower risk, lower return strategy where you don't invest into the companies, but really in the rollout of projects. So rather than buying a company that produces a certain technology, you're just buying the technology and really rolling out the projects. And that's part of the LTIF fund as well. So it's a bit more European, and there's also some infrastructure exposure in there.
And if you're looking to learn more about that program or access to Climate Tech Fund, we will have a webinar on it next week about it. So you can find it on our website and dial in as well. I think this is all the questions we've received so far. We can hang around for a minute, but if there's no further questions, I would just like to thank you all for participating and joining us today. And feel free to contact us further if you'd like to learn more.
Thanks a lot, everyone. Much appreciated. Have a nice day.